Hi everyone, my name is Ryan Kimmel from DoubleLine's macro asset allocation team. I want to spend a couple minutes walking you through the federal debt dynamic, which is obviously top of mind for investors. Last week, we saw Moody's downgrade the outlook on the US credit rating to outlook negative, and that was on the backdrop of a deteriorating fiscal trajectory, as well as continued political polarization. And that was following actions from Fitch, which over the summer, they downgraded US credit rating to AA from AAA. We're also seeing a bit of market indigestion as the market struggles to absorb the surge in Treasury issuance, which is creating quite a bit of term premium to be embedded in the long end of the yield curve. We're also seeing weak demand for the long end, which is indicated through weak Treasury auctions on the 30-year, which we saw last week. At the 40th Annual Grants Conference, DoubleLine's Chief Investment Officer and CEO, Jeffrey Gundlach, made the case for further fiscal deterioration in the US, which was supported by on a backdrop of higher rising interest rates. Mr. Gundlach's base case is that we are entering a secular period of rising rates that could support the interest burden for the US government, which turns into a self-reinforcing environment of higher interest rates feeding into higher deficits, which feeds into higher debt loads. So in this presentation, I'm going to walk you through the analysis that Mr. Gundlach presented, provide some more details, and the underlying assumptions backing that analysis. On our first chart here, this shows the current state of the US fiscal trajectory. And what you can see is that the fiscal budget balance at currently 6.3% of GDP is the highest level outside the global financial crisis and the 2020 pandemic, which were both two periods when the economy was in severe contraction with unemployment rates at 10% or higher. You contrast that to the current cycle where we're in an economic expansion and the unemployment rate is sub 4%. Which really begs the question, where is the fiscal deficit going to go when we eventually fall into recession, which is DoubleLine's base case over the coming quarters. And while that 6.3% fiscal deficit may seem eye-popping, the actual numbers might even be worse than what's officially reported. This chart here shows US fiscal year deficits as reported and adjusted for planned student loan cancellations as estimated from the Congressional Budget Office, the CBO. And what you can see is after accounting for the planned student loan cancellations that was reversed by the Supreme Court in June of this year, you can see that a pretty significant deterioration in the fiscal trajectory. In fiscal year 2022, the fiscal deficit was around 4% of GDP, and that has deteriorated to around 7.5% for fiscal year 2023. And those sustained deficits are feeding into higher and higher debt loads. You can see on this chart here, this shows federal debt held by the public as a percent of GDP. And what you can see is that prior to the global financial crisis, we're running relatively low debt loads with debt to GDP levels sub 40%. But since the financial crisis, we've seen a persistent increase in the level of debt relative to GDP. And currently, we're just under 100% debt to GDP levels, which is the highest level going back to World War II in the 1940s. And on a nominal basis, in dollar terms, the debt level is over 26 trillion. And perhaps even more concerning is that the debt levels are increasing at a faster pace than many economists are projecting. And this chart here shows the 10-year projections for US Treasury debt as a percent of GDP. This is from the CBO. And every year, they've essentially had to revise higher their debt forecasts. And what you can see is the gray line, it's their current forecast from 2023. They're projecting debt to GDP levels of around 120% of GDP. And if past is prologue, I would have to take the over on this 120% forecast. And this is where the fiscal dynamic gets a bit sticky and more complex. So this chart shows the average interest on US Treasury debt outstanding, that's the white line, and the yellow line is the yield on 10-year treasuries. And you can see over the past 20 years, we've been in a secular decline in interest rates, and the interest rate environment has been very benign in the post-GFC era. That changed abruptly in 2022 as the Fed had to aggressively hike policy rates in response to the uptick, the surge in inflation, and that's led the average interest on debt outstanding to go from a benign 1.5% interest at the beginning of 2022 to over 3% where we currently stand. And given where the current yields are across the curve, and you see here on the 10-year at 490 when we printed this, it's indicating that interest rates should be pushing higher over the coming years. And that is an issue given the large debt loads, as I showed in previous charts. This chart here shows the federal interest expense as a share of federal revenue, so a share of total tax receipts. And you see at 16%, that's the highest level going back to the 1980s and 1990s, which was a period when interest rates were higher, but the debt loads were much lower. So given the debt levels that we're seeing now with near 100% debt to GDP levels, it's not going to take much to take this number materially higher. And the CBO is projecting, their baseline forecast is that interest expense as a share of federal revenue is going to move around to 20% by 2033. So I wanted to show some scenario analysis to highlight the point how sensitive the fiscal dynamics are to different levels of interest rates. So on this chart here, this just shows the interest rate scenarios that I'm running on the fiscal backdrop. The black line here shows the average interest rate on federal debt, and the dashed lines are the projections. So the black line is the projection from the CBO, their baseline. The green line is 3% interest, which is more or less in line with the CBO's forecast. The golden line shows the path for 6% interest rates, and the red line shows the path for 9% interest rates. And given that it takes time for spot interest rates to feed through into the underlying stock of debt, you don't hit those terminal interest rates until 2027. The first chart here shows government interest expense as a share of tax revenue. I'm using the CBO's assumptions for GDP, tax revenues, and non-interest outlays, or otherwise known as the primary deficit. And what you see here is that the CBO, as I said earlier, is projecting that interest expense is going to rise to 20% of total revenues by 2033, which is in line with the 3% scenario in green. However, if interest rates move up to 6%, the interest expense as a share of tax revenue is going to rise up to 45%. And if we see 9% interest rates, we're going to see interest expense of 80% of tax revenue. Now, how does that feed into the budget deficit? On this chart here, you can see this is the budget deficit as a share of GDP. So right now, the CBO's baseline projection is for the budget deficit to hover around 6% of GDP and deteriorate to around 7% of GDP by 2033, which is more or less in line with that 3% interest rate scenario. But if interest rates move up to 6% over that time period, as signaled by the golden line here, you could see budget deficits decline to around 12% of GDP by 2033, which would be worse than the peak that we saw during the global financial crisis. And if interest rates move to 9% over that period, we could see the budget deficit deteriorate to around 17 to 18% of GDP, which would be significantly higher than the peak deficit spending we saw during 2020. And how that feeds into the debt loads, you can see on this chart here, which shows federal debt as a share of GDP. Right now, the CBO is forecasting debt to GDP levels by 2033 to be around 120%, which again is in line with the 3% scenario. However, with 6% interest rates, the debt to GDP level could reach 150%. Under 9% scenarios, we could see the debt to GDP reach 180%. That analysis was based on the CBO's baseline assumptions, where they're assuming roughly a 3% primary deficit over the next 10 years. If we make the assumption that the primary deficit is around 5%, which has been the average primary deficit in the post-GFC era, the fiscal dynamic deteriorates a bit more rapidly. So this chart here, this uses the primary deficit of 5% of GDP assumption, and we're showing that government interest expense as a share of tax revenue. And as I showed earlier, the CBO is projecting interest expense as a share of tax revenue to be around 20% by 2033, With 3% interest, it's slightly higher, but with 6% interest rates, you're going to see interest expense as a share of tax revenue above 50%. So over 50% of tax receipts are going to go to the interest burden for the government. And then under a 9% scenario, over 90% of tax revenues will be going towards the interest burden, leaving less than 10% available for other spending like Social Security, Medicare, defense spending, etc. And on the deficit, using the 5% primary deficit assumptions, instead of 6 to 7% deficits as projected by the CBO, we could see 8 to 9% deficit spending as implied by the 3% scenario. With a 6% interest rate scenario, the deficit declines and deteriorates almost to 15% by 2033. And under the 9% interest rate scenario, the deficit declines to over 20%, which would be the highest deficit spending going back to World War II. And finally, how that feeds into the overall debt load, looking at the debt as a share of GDP. The CBO, as I said before, is projecting 120% debt to GDP by 2033. Under the 5% primary deficit assumption and 3% interest rates, that number climbs to 140% by 2033. And for 6%, which is the golden line, we could see 170% debt to GDP levels by 2033. And then finally, for the 9% scenario, we'd see over 200% debt to GDP levels by 2033. So what does all this mean for the economy and financial markets? Well, higher interest rates will feed through into higher debt loads, and those higher debt loads could eventually crowd out private capital formation. And in response to the higher interest burden, the government will have to increase taxes and reduce government spending, which combined are negative for economic activity going forward. And you get to a point where at some point, the debt loads become so high that the economy collapses on itself under the weight of its own debt. This is known more commonly as a debt spiral. And a lot of work's been done on trying to identify at what point you reach this point of no return on the debt load. And there was a recent note out from economists at Wharton School of Business where they believe that level can be somewhere around 175 to 200% debt to GDP levels. So using our framework, under the higher interest rate regime of 6 to 9%, we could see debt to GDP levels around those levels within 10 years. So needless to say, U.S. politicians need to start paying particularly more attention to the fiscal dynamics in the U.S. Unfortunately, it doesn't appear to be top of mind for politicians at the moment. But what I can say is that investors and financial markets are going to be paying particularly close attention to the U.S. fiscal backdrop, not only in the quarters ahead, but in the years down the line, as eventually could become pretty significant for global financial markets. So with that, I hope you enjoyed this presentation. If you have any more questions or need more information, you can reach out to us at info@doubleline.com. We'll also post the link to Jeffrey Gundlach's presentation at the 40th Annual Grants Conference in the notes. And with that, thank you and goodbye for now.